Okay, well, let's get started. Thanks so much for coming this evening. We hope you find the presentation of help to you. And just before we get started, I just wanted to alert you to two upcoming webinars we have, one in August and one in September. In August, we're doing a webinar on Medicare. Um, Before too long, those of you that are either 65 or will be coming 65, your mailboxes will begin filling up with literature from all the companies here in Connecticut, both Medicare Advantage, prescription plans, and supplements. So it's kind of like you get hit each company with three different products. Um, Joe Namath will be popping up on TV every 30 seconds. I always think I'm playing whack-a-mole when I try to change the channel because he pops up on a commercial, and I no sooner get to the other channel and he pops up again on a commercial on that channel. But hopefully, we'll through this webinar, we'll be able to answer some of the questions, remove some of the complexity of the decisions that you're going to need to make this fall if you're already on Medicare and it's enrolling. Renewing, or for those that are getting close to age 65 that are going to have to make that decision. In September, we're going to be doing a repeat of the webinar we did last year in the fall, which was the webinar about document management and organizing, document organizer and life planner. So we'll be doing that in the fall. I think it's the I'm not sure about the September date, but I believe that the August date I think is the 21st of August. It's a Wednesday. So whatever that Wednesday is that week, that's when we're doing that one. So let me get started and share my screen and let me know. And by raising your hand, let me know if you can now see what's on my screen. It should be a compass. Okay, so that may mean that nobody can see my compass. Hold on just a sec. I'm going to stop the share and we're going to try that a second. We're going to try that a second time. Let's see, screen one, screen two. Let's try this again. Okay. Thank you. Somebody raise their hand and we'll move forward now that we can see the compass up on the screen. If you have any questions as we go along, please enter them in the Q&A down below. Just hit the Q&A, type it in, and we'll answer all those questions at the end of the workshop. We should have plenty of time for questions. So we're going to be talking about mid-year, and basically the key to what happens for the balance of the year is really what the Fed does. This is kind of that pivotal quarter where the expectation is that either towards the end of this quarter, very beginning of next quarter, we probably will see the first rate cut that the Fed will do. And the investing public has been a little uh, optimistic in terms of how many rate cuts we were going to have this year. Early on in the year, I think we talked in January that the investors were expecting the first rate cut to come in March, and they were expecting, 6 to 7 rate cuts. They were expecting somewhere between 1.5% and 1.75% cuts in the Fed. A cut is 0.25, a quarter of a percent. So if the Fed were to cut 0.5%, that counts at one time. That counts as 2 rate cuts. So naturally, we got no rate cut in March, and here we are in August, still no rate cut. So that created a lot of volatility in the market because the market priced in these rate cuts, and when they didn't happen, the market kind of corrected back based on the reality of the situation. We had said at the beginning of the year that the institutional managers did not expect any rate cuts in the first half of the year, and the expectation for the year was probably 3 or 4. Right now, it's likely that we will have 1, maybe 2. The reason that the Fed feels that they probably can start decreasing interest rates is going to be discussed in the first part of this workshop. So as we move forward, let's talk about the economy because that's really what's been driving, been driving it. So as we look at the three sections, I got a little ahead of myself. The three sections we're going to talk about tonight: the economy, equities, which are stocks, and fixed income. So in terms of the economy, what we're looking at here in this bar graph is basically over the last year and a half, this has been the gross domestic product of the country. And basically each quarter, it's basically an annualized number. Now, the Fed, in their goal in terms of raising interest rates was to put a halt to the economy. Inflation was out of hand. And basically, the way the Fed has always handled inflation is to increase interest rates and keep increasing them until you force the economy into a recession. So basically, they started increasing interest rates in 2022. They actually stopped last July. So we haven't had a rate increase since last July, but we haven't had a decrease either. Now, in the first 2 quarters of last year, basically we saw pretty modest projections, or at least when they annualized the quarterly, of a little over 2, right around 2% growth. And then suddenly in the third quarter, we had an unexpected spike in the gross domestic product, and basically we reached almost 5% at that point and retreated back down to about 3.5% in the fourth quarter. Still too high. The Fed was still concerned that the economy was too hot and that interest rates, that inflation was not coming down. And so basically, although they put a halt to it because the inflation was starting to trend down, they had no plans to decrease it. And when we got to the beginning of this year, coming off 2 very hot quarters for the economy, basically the handwriting was on the wall that these rate cuts weren't going to come too soon. The first quarter brought some good news in that the economy actually slowed down to only about 1.5%. And although the final numbers aren't to us yet for the second quarter, the belief is that the second quarter is going to be somewhere around 2%, and that the expectation is that for the year, we're probably going to finish somewhere in 2.5%, which would indicate what they call a soft landing. Some call it a Goldilocks situation. And what is meant by that is that while the Fed's goal is to cause a recession because that's the way historically we've taken care of inflation. Basically, a soft landing means that the Fed, when they do reach their pivot point, which means to start decreasing interest rates, are going to do that before we have a recession. And the reason that we're not going to have a recession has to do with the labor market. uh, basically employment is too high. You can't have a recession when you have help wanted signs in all the windows. And so basically right now the economy, because of the labor market, is causing wages to go up because of the competition for people. And when wages go up, people spend money. Hard to get inflation down when people are spending money, but that's starting to cool down. um, Unemployment's still at a great number, and that's why we're not going to have a recession, but it has gone up. But the big thing is that where a year ago we had 2 job openings for every person looking for a job, right now it's down about 1.3. So there's only about 1.3 openings for every person looking for a job, and that's actually reaching kind of normalcy. And so at this point, the Fed is confident that things are going in the right direction. When we look at inflation, which is what they've been fighting. And inflation um, is hard to understand because when we go to the grocery store, when we go out to eat, when we buy our gas, we're still seeing pretty high prices, and we're still seeing increases in those prices. The reason that inflation is going down and we don't feel it is because the Fed uses core inflation, which does not include energy or food. And the reason it doesn't is because those are impacted by different factors than the rest of inflation. They don't correlate very well to the rest of the elements in the CPI, and they're impacted by things like food is really impacted by weather primarily. Freight has some influence on it. What's the cost of freight? But if you have a drought and it wipes out the corn crop, anything related to corn or to wheat, if it's the wheat crop, goes up. And so therefore, they don't put those in. Oil fuel barrel goes up based on OPEC decides they're going to cut production, up it goes. So it's not impacted by the economy like the rest of it. So when the government or when Biden says we got inflation under control, core inflation is getting under control. But the problem is when we go out to eat, when we go to the grocery store, when we buy gasoline at the pump, it is still high and climbing. The other thing is that the Fed really doesn't even look anymore at CPI. They have a PCE. PCE is inflation rate, removing things that can be substituted for other items. So if the price of beef goes way up, people stop eating as much beef and they buy chicken. And so the Fed has an a CPI that they look at, an inflation rate that they look at that basically takes out items or discounts items that can be substituted, maybe tea for coffee. People turn to tea rather than drinking as much coffee. And so right now we're looking at a situation where food is still high. So cost of eating out, a $2 hamburger of a year ago was a $3 hamburger today. The other thing is that when we look at this is the history of inflation over the last nearly 10 years, we can see very low inflation here until we got to 2022 post-COVID. And then up it spiked and it was high here, started coming down and suddenly it spiked back up again right here. Now, and now the latest reports, it's been coming down. We had a great, last report here see, we're enjoying May. Inflation was way down. Now, the other thing is consumers look at this chart, and when they see this, they think it tells us that prices are coming down. Okay. Inflation, rarely do we go back to where were. Food and energy, yes, because they're impacted by so, but general inflation, once you have a price increase, unless you get a recession and people stop buying, prices don't go back down. These numbers here, even this, this is not a decrease in prices. It's simply a decrease in the rate of increase. So inflation isn't going up as much here because it's down at less than 2% last month versus way over here where it was up around 10% inflation rate. But the Fed has already stated that although their goal is 2%, they don't need it to get to 2 for them to start decreasing interest rates. And they don't believe it's going to get to 2 probably until the year after next. They expect next year probably to be down in the 2 to 2.5% range, and it won't get to 2 until 2026. But they believe that they can start cutting interest rates. They're not going to cut them very fast. They do not want to return to the early 1980s. In the early 1980s, they took the foot off the pedal and they brought the interest rates down, and inflation came back, and they had to bring the interest rates back up again. And so they don't want a repeat of that. Now, when we look at long-term inflation, and by long-term, I mean going back over the last 50 years, the last 5.5 decades, What we see here right in the middle with this dark blue line is the current decade. So we're about 4.5 years into that decade. And this is the cumulative cost and prices for that decade. So right now we're up around 20% of where we were at the beginning. But you can tell here for the first year to year and not much, and then suddenly it went up, and now we flattened out a little bit. But if we look at some of these other lines, and some of us on this call may not have been consumers when we look at those two top lines, but that blue line is the 1970s. And basically in the 1970s, especially the late 70s, and you can certainly see this spike up here, we had inflation that was double digit, we had unemployment that was double digit, and we had interest rates that were double digit. Around 1980, you could get a CD, a money market fund for over 15%. Of course, you had inflation that was well over 10% at that same period of time. The next decade was a little cooler, although in the beginning you can see here when they took their foot off of they were fighting inflation here. They started to make some headway and they took their foot off the pedal and inflation came back. And so they had to bring interest rates up, I'm sorry, and that flattened the curve a little bit there. But you can see here that blue line in the 1970s, prices more than doubled for that decade. They were up 100%. And even in the 80s, we were up almost 60% here in the 19, actually a little over 60% in the 1980s. And then our more recent history, most recent history right here, this green line, this was the teens, the last full decade. And you can see that was of the last 50 years, that interest rate was very low. Barely, it didn't even hit 20% cumulative for the decade. And for many, down here, as I mentioned in the beginning, the green line didn't even start up to here. The red line basically was the first 10 years of this century. Right here, we see the financial crisis, and basically, we see the prices actually came down now during that period of time, as they did back here in the 1980s during a recession. And then finally, the yellow line was the 1990s, where we had a cumulative rate of return that was over 30%. So we're probably going to approach that yellow line for the current decade. But again, we still have about 5 years left to run, for that decade. Now, most of the GMP for our country is consumer spending, and when consumers spend, the economy goes. Consumer spending was very strong in the second half of last year. That's why the economy took off. The gross domestic product was so high. As we look at this screen, we look at two recessions. We look at the financial crisis, '08. When we look at COVID right here, and what we can see is in both of those periods of time, we had a dip in consumer spending, and basically that's what caused the recession. Consumers stopped spending. Here, consumers stopped spending because we couldn't go out and spend. But as soon as we could, it very quickly came back to about norm, where the trend, and then it just spiked way up. That pent up demand, the money that was paid out during COVID that people didn't spend, suddenly got spent, and we just saw spending go sky high, and with it, inflation came up, and it's kind of plateaued out, and now it's starting to come down a little bit. This next graph, we're looking at something called the Economic Surprise Index. The Economic Surprise Index, basically, if it's above the line, it means the results exceeded the projections or expectations. If it's below the line, it means the results didn't meet the expectations. And as we look over the last 3 years, we can see that in post-COVID, we can see that the economy was doing better than anybody projected. We got into the end of 2021 and it went the opposite way. 2022, even though the market was down the beginning of the year, the surprise index in terms of the economy, it was actually outperforming what they said. Now, again, whether it outperforms or underperforms, a lot of that has to do with what were the projections? How optimistic, how pessimistic were they? But you can see here that basically at the start of the second quarter of this year, we saw a big drop, as we had seen at the end of the prior year, a big drop in the surprise index, meaning that we're underperforming right now what the expectations were. Despite that, we're not expecting a recession because, again, the labor market is still too healthy. And so no one is forecasting a recession. Not that there couldn't be a surprise. If we look back, the recession in the stock market, bear market at the beginning of this century was really caused by the fact that in the late 90s, uh, the tech bubble, stocks were selling at many multiples of what they should have been selling based on the earnings or the projected earnings of those companies. The financial crisis was caused by the real estate and the bond market, because bonds were suddenly to create mortgage money. They became very creative in how to put these bond packages together. They fooled Moody's and Standard and Poor's, and we had junk bond funds that were rated AAA. People were getting mortgages that there was no way they could ever afford. And so that was caused by that. But right now, we don't really see any bubbles. People will say, well, what about NVIDIA? What? Well, the earnings projections for NVIDIA are so far, and the other companies in the S&P are so far different than they were back here. Earnings are expected to climb dramatically. This year they're expecting profits for corporations and sales to be up between 5 and 10%, profits up between 10 and 15, and a repeat for next year of the same. So even though we're pretty high, and we're going to look at a couple of charts with the stock market when we get into the equities next, that basically shows that this is not a repeat of the tech bubble from back in 1999. So moving forward, let's talk about equities or stocks at this point in time. And there's two types of stocks, growth and value. And it doesn't matter whether you're dealing with small cap, mid cap, or large cap. Basically, they fall into a growth or value area. And predominantly, your growth stocks tend to be things like your tech stocks. Your tech stocks fall into the growth area. Your value stocks tend to be things like financials and healthcare. And historically, we've had relatively long periods of time where growth has outperformed value, value has outperformed growth. And what we can see here is back in the 90s, the tech bubble, growth outperformed. And why? Because tech was driving the market at that point. And then we see that the tech bubble came, and for a long time, oops, I'm sorry, my cursor was a little too sensitive there. So for a long period of time, from the beginning of this century until almost the end of the second decade, value outperformed growth. And now we've seen that growth has been outperforming value. Now, when growth outperforms value by more than 25%, okay, within 6 months, it flips and value starts performing. I say it flips because historically it has. You can't predict the future, but you can only go by history and what has happened in history. So we're expecting at some point that the value-oriented stocks will start coming back, if not to come down here, but at least to come down into an area where there's only slight outperformance there. Your value stocks tend to be more your dividend, your constant dividend paying stocks also. Okay. Now, with the S&P 500, over different periods of time, we've seen where a handful of stocks have really been heavily weighted in there because of their size. So when we go back to the end of the tech bubble, we can see that the top 10 stocks in the S&P 500 represented over 40% of the weight of the S&P 500. The other 490 only represented 60% of the weight. We saw that fall. We saw until we got right here in the mid-teens. and we saw that those 10 stocks were only about 20%, a little less than 20% of the weighting. And we've seen that steadily climb. What happened here? This was 2022. Okay. Now, why did this go from here to here? Why did this go from here to here? Well, it's because the biggest stocks in the S&P 500 had a bad year. Nvidia did great in 2023, no question about it, but it was down over 50% the year before. So all it was doing was attempting to come back to even, and it didn't come back to even until 2024. When a stock is down 50%, it needs to be up 100% to come back to even. If a stock's down 10, it only needs to go up 11% to come back to even. So what happens is when these big stocks do well, the index flies. When these biggest stock, and it's not the same 10 stocks. They wasn't the same 10 stocks back here. But right here, the Magnificent Seven, those top 10, seven of the 10 companies had a very bad year. Those seven companies are now down to five. They call them the Fab Five now, because Tesla and Apple, because their stock has really gotten beaten up this year, is no longer part of that Magnificent Seven, which includes Meta, which is Facebook, Alphabet, which is Google, Microsoft is still in there. Who am I missing? Nvidia is still in there, and I'm still missing one of those seven in there. So people that invest in the index will rise and fall based on those particular companies. Now, what people use, as a value of whether a stock is selling at a expensive price or a cheap price is basically PE, or price earnings. What's the price of the stock compared to the earnings? How many times earnings is it selling? And we can see back in 2000, it was off the chart, that there were stocks selling for basically 70 times what the earnings were. And I remember back then that, Dell Computers was really hot in the late, they came out with, build your own computer online, and they were the hottest, computer on, in the marketplace at that point. And Michael Dell said, he says, no, he says, we're expecting a great next 5 to 10 years, but there is no way that we can ever produce enough earnings to justify our current share price. And there were companies, so many of these .com companies, which really, they were IPOs, they skyrocketed, they really had no track record, they had no assets. I had a company across the hall from me called CMG that was selling for $170 a share. And it had just gone off the chart in terms of increases. 2000 hit, and that company went out of business. And so many companies did. As you can see, although the PE is pretty high because this is the average, we're only about half of where we were back here in terms of the most expensive companies, that the tech being in there. And so the good news also, first of all, with that is the future earnings are pretty high, expected, the projections for these companies. The other thing is that the other 490 companies that are in the index basically are pretty good companies right now. Their fundamentals are strong. They're undervalued. The PE of the rest of the index is below 20. So it's below the historical averages there. So, when you look at those other, and things are coming, both the earnings and the prices are coming back, so that these other 490 are catching up to the top, which means there's a tremendous opportunity for investment managers to start underweighting these big tech companies. They're not bailing out of them because they still think there's some room for growth there, but they're bailing out at a high price to buy something at a low price. While the index has been up over 20%, 30% last year, over 20% this year. If you equal weighted the index, I mean, in other words, if you took these 10 companies and you gave them the same weighting as the other 490, the market's only up 3%. because so many of those other 490 have actually been down. But basically, they've really been down not because they're bad companies, but because people are so excited about artificial intelligence that the money's been going into the those tech companies and really, blowing them off the chart. So even with these tech companies, the expectation is that we're going to have some short-term volatility for a variety of reasons for the next few months. One being the election. The couple months right before the election tends to have a lot of volatility. If it looks like the incumbent party is going to win, the market usually does good right before the election. If it looks like there's going to be a change, because uncertain market doesn't like uncertainty, they might not like what's happening, but if it's certain, they're happy with that. But basically, the market tends to be more volatile when it looks like the incumbent party is not going to win. But regardless, at the 2 months after the election, the market generally does very well. And so, that combined with the fact that next year the fundamentals look very good, the expectation is that the market is going to be pretty good for the coming year. The Fed right now, as I mentioned, either September or October is very likely going to be a rate cut, and possibly December. The Fed is saying we're only cutting once this year. We're only cutting twice in the beginning of next year. So, they're only looking at 0.75% over the next year. Most people think that, yeah, probably it's more likely that they're going to have more than three over the next year, but basically maybe one more in the first 6 months of next year. Let's talk a little bit about fixed income. For many years, fixed income was a great tailwind for a portfolio, a 60/40 portfolio. Bonds were performing very well because interest rates were coming down over a very long period of time from those highs around 1980, 1981, 1982 to almost zero in 2020. Um, Now, since then, rates have gone up. Uh, Bonds have not had a positive year since 2019. Part of that was due to the expectation that interest rates were going to start going up, and it took a lot longer for the Fed to start raising interest rates than people thought, and then probably a lot longer by their own admission than they should have. They should have started raising interest rates earlier than that. Now, when interest rates go up, what happens is bond prices go down. If you are holding a bond that's paying 1% and the interest rates go up to 2, and people can buy a new bond for 2, they're not going to buy your bond. Or at least they're not going to buy your bond for full price. Because why would they buy your bond that on $1,000 bond is paying out $10 when they can go buy a new $1,000 bond that's paying 20? But they will pay you less for your bond because they're going to still get the same $10. And if they can get it for half price, that's 2%. And they don't even have to discount it that much because they know whatever they buy it for, when it matures, it's going to mature for the full face value. If it's going to mature shortly, a year, 2 years from now, it doesn't get discounted all that much because the new investor only has to wait a year or two to get the full value. If it's a long-term bond, it's going to be discounted more. So when bond interest rates go down, the opposite happens. And where short-term interest or short-term increases in short-term bonds don't impact the price that much because it's going to mature soon, it does drive down long-term. The opposite happens when interest rates go down. And so the expectation in the short term is that interest rates will start going down. The Fed is really tied closest to the 2-year Treasury. And basically, the 2-year Treasury interest rate basically is what the investing public expects the Fed rate to be a year from now. And the 10-year Treasury bonds, basically, that's really what mortgages and long-term loans are based on, is the 10-year rate. Now, when the Fed starts decreasing the rate, it's not going to have that much impact on the 10-year rate. It's going to have impact on the shorter term rates. Now, that still means, though, that when interest rates start going down, the bonds that you own, not only will you be locked in at a higher rate, but also your price is going to go up because those bonds are going to be in demand because of their higher interest rate. And a 10-year is actually going to go up faster than a 5-year or a 3-year because people are going to be locked in at that higher interest rate for a longer period of time. And also, they can spread the premium they pay over a longer period of time. So the danger right now that people have have a lot of money, and there is a ton of money right now on that side in cash, which bodes well for the market, and that cash at some point is going to get invested. And the reason it's sitting in cash is it's earning 5%. But the danger is that when the interest rates start going down, those are going to do, if you're holding a 3-month CD, at the end of 3 months, it's probably, right now, maybe not change too much, but a 6-month one, yeah, it's going to go down. And the problem is that if you wait too long, when it goes down, the other prices of bonds on the longer term have gone up. The market has probably gone up. And we see now the institutional bond managers are starting to move their portfolios from short duration, meaning a couple years, to a much longer duration. They're not jumping into it, but they're gradually making that move over. But right now, the 10-year rate or the 2-year rate is about 4.5%. The Fed rate right now is about 5.25 to 5.5. So basically, that means that based on that number, the investing public believes that there's going to be likely be three rate cuts in the next year, and that's where some of these projections are coming from in terms of a rate cut this year and then two more in the first 6 months of next year. Right now, we've had two things have been happening. First of all, we've had an inverted rate curve, which basically means that your long-term rate should be paying you more interest. When you buy a CD, your short-term CDs pay less interest than your the long-term CDs do. That's been inverted, and it's been inverted because of the Fed rate going up so fast that right now short-term rates have been about 1% better than the long-term rates. Usually that kind of comes ahead of a recession. But because this is an unusual period of time with the labor market being so strong, even though we've had an inverted rate curve, it's getting closer, to where it was before. And so basically, we're seeing that a combination of two things happening. High yield is coming down, so the spread is becoming lower, and it's actually below the average. And short term, or when they start coming down, we're going to see that curve go back to normal spread. This is one of my favorite slides, and I think when we did our beginning of the year review, I think I shared this slide at that point in time. When we look at this slide, and this is basically the last roughly 45 years, what we see is that there's a lot more bars above the line, which basically means these were all the up years over the last 45 years. And there are far more years above the line than there are below. There's 8 years below the line. A couple of those years were not very big downs, down 4, down 3, down 5. And this year here, which was 2018, what was interesting about that year is the entire down in the market came right in the last week of the year. Christmas Eve had a big drop. And basically, the market was positive leading up to that day. And that slight positive went to a negative of about 4.5%. But as you can see, the three downs basically that we experienced over the period of time, tech bubble, financial crisis, and then last year, 2020, so actually 2 years ago now, 2022. The other thing I note with the downs is that there was only one period where when we had a bear market, and these weren't considered bear markets because they weren't even considered corrections because they were down less than 10%. But this is the only time in the last 45 years where we had more than 1 year that the market was down. And actually, this, which was 2001, leading into the fall, late summer, the market looked like it was going to finish the year up that year. And then 9/11 came, that drove the market back down. And also, not only was it still recovering from there, but in this period of time, that's where we had the WorldCom issue, the Enron issue. And so there were a lot of shocks to the market with these companies that were thought to be well-known, quality, big revenue-producing companies, found that they were built on sticks, and they can collapse it now, and kept the market down also. The other thing this chart is demonstrating is these blue dots represent what the drop in the market was during the course of the 12-month period of the year. And what's remarkable here is we see some drops like in this year, where the drop was during the year, the market went down 27%, and yet the market finished at the end of the year up 26%. We see the same thing here, which happened to be the COVID year. So an unusual year. Market was down 35% on March 17th, ended up the year almost 20. But we even see, we see so many years where the market was down some pretty big numbers. I mean, these markets was well into bear market territory, bear market. And certainly these years it stayed down, but not as much as the biggest drop. So there is short-term volatility in the market. The price that we pay for long-term results in the market really is the short-term volatility. And the problem is that people react to that short-term volatility. They react to the market dropping. They react to occurrences happening. And, it's unusual. There's charts, and I was looking at one earlier today that basically was showing over the last 20 years, including Y2K, tech bubble, 9/11, Iraq war, how far the market went down, and the short term right after that, and what's been the return since then. I mean, we see 9/11, the market went down 30%. If you had dropped out of the market at that point, who knows when you would have returned, but the market since then has been up over 3.5 times. And so when you have long-term investment goals, staying invested despite what's happening is really important. The market over long periods of time, the returns have historically been very predictable. That when we look at 15-year periods, rolling 15-year periods, the market reaches its historical return almost 100% of the time, 99.6% of the time. And in the years it didn't, at 0.4, it still was performed far better than any other investment class. 10-year periods, the market 98%, 96.8%. The market exceeds its historical returns, and still, with the exception of one, I think two 10-year periods, the market still was highly positive during those periods of time. But on the short term, as we can see here, the market is very volatile. It's unpredictable. And therefore, in short periods of time, when you're accumulating money, volatility is your friend because you're not pulling money out of your investments. And so your average rate of return is the same, or your cumulative rate is the same, regardless of when the ups and downs come. In retirement or in distribution, if it's some other goal, basically the rules are very different in investing money, and you can't afford to have money that you're going to need invested in the market because of its unpredictability. And you have to make sure that in retirement that you're aligning your liabilities, which are your cash needs for income or purchases, with the asset class. So we focus on your long-term needs, even in retirement, being invested in the market to offset inflation. But your term needs, you need to avoid the volatility. The volatility, complicates things when investors make moves either because they have to, it's part of their plan or because they're scared. Investors historically basically have underperformed other investments, and it's not because their costs were too high, because the margin is just too great. It's really because they bought on the down, they sold on the downs and they bought on the highs. And when we look at the market over the last 20 years, the U.S. stock market's up almost 10%. Uh, Real estate, REITs, not commercial, but investing in REITs, real estate investment trusts, 8.5. International up 7. Homes during that period of time have gone up a lot, almost 4%. Average investor 3.1. Government bonds 2.7. Inflation has been 2.5. And cash was less than inflation. So you actually lost buying power on cash. But important that, beating the index is great, but beating the assumed rate of return in your plan is what's critical. It doesn't matter if you beat the index when it was down 10%. And if the assumption in your plan is 5 and you're not exceeding 5, say, your plan is going to have some stress to it. Important that you stick to the plan as we look at the coming year. Diversification critically important in retirement when you're accumulating money and you have many years before you're going to need that money. Being fully invested and very heavily invested on the equity side, as long as you stay in the market, you're going to be rewarded, based on history, with good returns. You're just going to have that short-term volatility of the market. So let me move forward here and see if there's any questions. I have Diane on the call. She's been monitoring the questions. So let me stop the share here and see. Diane, are there any questions in the queue?
No, not as of yet.
Okay. Now I don't know if the hand was raised from earlier. I'm going to lower the hand, and if I lowered your hand and you intended to have it up, just raise it back up again. Because if we recognize the raised hand, you'll be live. If you do want to ask a question live, we'd certainly take a question, live there. And while we're waiting for some questions, the other thing I just wanted to point out, over history, historical periods of time, you know, again, when there's been geopolitical risk, which is probably one of the only red signs right now, a lot of these investment companies produce these speedometers or these all ahead, like on the ship. I forget what they call those right now. Most of those signals right now are either neutral or green. The geopolitical risk is one of those, one of two that is currently red. But geopolitical risk usually only causes a short-term hit to the market because the market overreacts to good and bad news. And sometimes good news is taken by the market as bad news. And not panicking and making moves is important. When we look at the since 1926, I mean, that's a lot of years. But basically over those years, the market was positive 72 years, negative 26. And basically it's been positive 73% of the time. 20% of the time, or 37 years, market returned over 20%. 21 years between 10 and 20, 14 between 0 and 10. While there were 37 years where it was over 20, there was only 6 years where it was less than 20. Two of those years were in our recent history, '02 and '08, where the market both those years dipped below 20% down. I remember my first year in the business, the market was down more than 20% that year. There was only 6 years where the market was down between 10 and 20. So 12 years out of over 100, about roughly 100 years, the market was down more than 10. But the chart, I don't know, sometimes these don't but you can see over here that there's been a lot of up years in the market, and most people get hurt because they bail out in the down years. Any questions yet, Diane?
Nope, no questions.
Okay, well, I'm gonna close just again reminding you we have a workshop, a virtual workshop on August 21st on Medicare. The open enrollment, annual enrollment period is coming. So certainly when you get those invites, if you know people that are confused by Medicare, feel free to pass an invite along to them. Pass the link along. We would be glad to help them kind of clarify before the mailboxes start filling up this fall for those over 65, before every other ad on TV is a Medicare Advantage ad. Perhaps we can answer a lot of the questions ahead of time and tell you what to be looking for in the coming season. And then September, we'll be doing a repeat of last fall's document management workshop where we talk about how you should store your documents, where you should keep them, who should know about them, how long you should keep them. And everybody that attends that, we provide a copy of our document management system as well as a fireproof safe, which you would think would be heavy metal, but they actually make these fireproof safes out of some sort of fire retardant material. They come in a flat box, they open up, and they're very, very light. But I know we have a date for it. I just can't. You know what? And you recall what the date is for the September one offhand, Diane? I know it's around the third. I think it's around the third week of the month, but the invites will be coming out, a week or two ahead of both of those workshops, and so we would welcome that you attend. And we thank you so much for attending tonight. If any questions come up, after the workshop that you can think of, just reach out to us. Glad to answer them. But we appreciate you attending tonight. We are recording this, and as long as compliance gives their blessing, we will be posting, the replay on both our website as well as our YouTube channel. So, look for that, coming up. Probably compliance usually takes about, by the time we put the leads and the tails and the disclosures in there, and then compliance approves it, we're probably looking at a couple weeks out before we see that approval. So thanks so much for attending. Hope you can attend in August. Good night.